All right, today we're going to put a true corporate giant, AT&T, right under the microscope. But we're not just going to glance at its stock price. Nope. We're going to analyze it through the eyes of a legendary value investor, using a powerful checklist to figure out if this company is a real bargain or if it just looks cheap. Let's dig into the data. So before we jump into the numbers, let's get our mindset right. When you think like a value investor, you're not a speculator chasing charts. You're more like a detective. You're on a mission, really, to answer two simple but crucial questions. First, is this a wonderful business? And second, can I buy it at a fair price? That's the lens we're going to be using today. So here's our four-step game plan. We're going to start by asking if the price is right. Then we'll give the company a full financial health check. After that, we'll see if it's growing and rewarding its shareholders. And finally, we'll put it all together for the final scorecard. First things first, a true value investor is always hunting for a bargain. The whole point isn't just to buy a good company, it's to buy it for way less than it's actually worth. So let's kick things off by investigating AT&T's price tag. Now, the most important tool for any value investor is this idea of a margin of safety. It's a pretty simple concept, really. You figure out what you think a business is truly worth, and then you try to buy it for a lot less. Think of it like buying a $100 item that's on sale for $70. That $30 discount is your cushion, your protection, just in case you were a little bit wrong about your first estimate.
And right away, we have our first big clue. Based on the data, AT&T appears to have a margin of safety of 23%. So what does that mean? It means the stock seems to be trading at a 23% discount to what its estimated fair value is. For anyone hunting for value, that's a blinking light that says, hey, you should probably take a closer look here.
Okay, let's add another classic tool into the mix, the price-to-earnings, or PE ratio. And what's really interesting here isn't just today's number, it's the trend. Right now, AT&T's PE is under 9. But if you look at its average over the last 5 years, it's almost 15. That's a drop of over 40%. It tells us the market is paying a whole lot less for every dollar of AT&T's earnings than it used to. And you know, it's not just a one-off. Other key metrics are telling a similar story. Whether you're looking at the price compared to its free cash flow, or the earnings yield, or even the PEG ratio, which factors in growth, the message is pretty consistent. From a pure valuation standpoint, these numbers are all suggesting that AT&T could be on the bargain rack. But hold on, a cheap price is only half the puzzle. I mean, a stock can be cheap for a really, really good reason, like if the business is falling apart. So now we've got to look under the hood. Is the company itself actually strong and healthy? First up, let's look at return on equity, or ROE. This basically tells us how good the company is at making money using its shareholders' money. And at almost 20%, AT&T's ROE is really strong. That suggests the management team is doing a very effective job of turning investors' cash into actual profits. Next, we've got return on invested capital, or ROCIC. Now, this is a bit of a tougher measure because it looks at all the money the company uses, including debt, not just the shareholders' part. Here, the number is closer to 6%. It's still a solid, healthy return, for sure, but it does paint a slightly more measured picture of the company's efficiency than that super high ROE did. Okay, now we have to talk about debt. The debt-to-equity ratio is sitting at 1.23. What that means is for every $1 that shareholders own, the company has about $1.23 in debt. You know, for a lot of value investors, any number over 1 is a bit of a yellow flag. It points to a higher level of financial risk, so that's definitely something we need to keep in the back of our minds. All right, so we've checked the price, we've looked at the company's health. Time for the third part of our checklist, growth and rewards. Is this business actually getting bigger? And maybe just as important, is it sharing the wealth with the people who own it? Now this is a really interesting puzzle. Check this out. Over the last 5 years, AT&T's total sales, its revenue, has actually been shrinking. But at the same time, its profits, its net income, have exploded, growing by over 43% per year. So how is that even possible? Well, it strongly suggests the company has been making some big changes, probably selling off parts of the business that weren't making much money to focus on what really works. It seems like it's become a much more efficient profit-making machine, even though the company itself has gotten smaller. So, what has all this meant for investors' wallets? Well, if we look at the total return, that's the stock price change plus the dividends, the story's pretty good, especially lately. The 3-year annualized return is a very impressive 16%. It's a bit more modest when you stretch it out to 5 or 10 years, but it still shows that if you held on, you've been rewarded.
And of course, for a company like AT&T, a huge part of that reward is the dividend. This chart shows us that right now, the company's paying out about 36% of its profits to shareholders as dividends. It's keeping the other 2/3 to reinvest back into the business. Now, on the surface, that looks great. It seems healthy, it seems sustainable. But, as any good detective will tell you, you have to look at all the clues. You can't just stop at the first thing you see. And when it comes to AT&T's dividend, there's another piece of evidence that tells a very, very different story.
And here it is. This is the catch. Even though today's payout ratio looks fine, the trend has been going in the absolute wrong direction. Over the last 5 years, the actual dividend paid per share has shrunk by an average of almost 7% every single year. For anyone who invests for income, a shrinking dividend is a massive red flag. Okay, we've collected the evidence, we've examined the price, the health, the growth, and the rewards. Now it's time to bring it all together, weigh the good against the bad, and fill out our final scorecard. And this really lays it all out. In one corner, you've got the bull case, the argument for buying. The stock looks cheap pretty much any way you slice it, and the underlying business is incredibly profitable. But in the other corner, you have the bear case, the argument against. The company's sales are shrinking, it's carrying a lot of debt, and it has been cutting its dividend. This is the classic dilemma every investor faces, a fight between what looks like a great value and some very clear risks. And all of this brings us to that timeless advice from Warren Buffett. Price is what you pay. Value is what you get. Our investigation has pretty clearly established that the price for AT&T stock looks low. The billion-dollar question that's left is whether the value you get, the actual business, is good enough to overcome those risks we found. So here's where we land. Our checklist has uncovered a company that shows strong signs of life when you look at its profitability and its valuation. But it also has some really worrying symptoms when it comes to its growth, its debt, and its dividend history. And that leaves us with the one question that every value investor has to answer for themselves. Is AT&T a genuine value opportunity just waiting to be picked up? Or is it a value trap, a stock that's cheap for a very good reason? Based on all the evidence we've just seen, which side of that line do you think it's on?